Assume you have invested 1 rupee in a system that returns you 15% every year. It might be an index fund, mutual fund, basically anything. So your first investment was at the age of 20. After 40 long years, that is at your 60, the value of this 1 rupee would be rupees 338, and the same 1 rupee would be at the value rupees 87 at the end of 50 years. So isn't it such a huge difference between just 10 years? Isn't it unbelievable? That's why Einstein called this eighth wonder of the world. This is called compounding. This is the power of compounding. So, hello guys, welcome to Details. This is D. Here we'll try to tell you everything we learn in detail. This is an informative video and not a financial advice. Please do your own research and move forward while you invest. Before beginning, please do hit that subscribe button. Simple interest means the interest on the total principal amount. But in the compound interest, it is the interest on the principal amount plus the accumulated interest over successive years. Actually, you don't need big amount to invest. You can invest a small amount every month which may change over time. This gives you more financial flexibility. Experts say you must invest at least 10% of your income in any of the system. You can invest in index fund or mutual fund. You can invest in RD. It depends on your risk taking capability. But now, let us look into some stats. Since its inception, that is over 20 years, Nifty 50 has returned 12.2% returns. Nifty 50 includes the top 50 market players of the country. But compared to Nifty 50, Nifty Next 50, which is the next top 50 companies, has returned 17.2%. This is slightly riskier than Nifty 50 as there is less stability compared to the top 50 companies in this next 50. Of course, this varies very much in the day-to-day basis, but over long term, it is very less riskier. You might have heard your elders saying that they have lost the money they have invested. It is just because lack of the knowledge and lack of patience. Basically, in the earlier days, what people used to do was that they used to give their money to some broker. That broker would have invested in some sort of companies as per his knowledge. But these investments didn't last too long. The people who had invested their money would want their money back after a short term. This is not how the market works. It varies on a day-to-day basis. So of course you got profit today, but it doesn't mean that you will get tomorrow. So it's very risky on the day-to-day basis. Now look at the COVID situation. Market dropped a lot due to lockdown and due to the people's emotion. Everybody started to sell their shares. But this is the time when you buy shares, not sell. Because you are sure that market is going to rise again. But it takes time. This is considered to be one of the largest drop after the financial crisis of 2008. So once the market rises back, net to net you get the positive impact. So now let's look at the Bombay Stock Exchange. Bombay Stock Exchange is very old. We have the data of over 40 years. So according to the data, it has returned an average of 16.9%. These returns are very higher than the normal FD or gold. Of course, FD and gold are the stable investment with less risks involved. But considering the younger generations, they are more capable of handling the risk. Now you are investing rupees 5000 every month for almost 40 years with 13% return. So your total investment amount would be 24 lakhs. But you will be having almost 8.09 crores. This is a massive growth. But you shouldn't forget inflation. So what is inflation? As the economy grows, the price of the item also increases, which in turn decreases the spending power of the people. India's almost average 5% inflation. Now look, the price of milk per liter this year may rise by 5% next year. It varies, but after 40 years, you get very much returns. But the price of the commodities also increases, which in turn increases your standard of living. This doesn't cancel each other. In turn, you still get the positive impact. You still get a large return. For example, after looking at the previous data, 90,000 rupees of 2040 is equivalent to the 20,000 rupees of 2020. This is all due to inflation. So it is always wise to invest in over the long term. You should be considering starting as early as possible. We were looking at the example of starting investing at the age of 20. Now instead you assume that you started at the age of 30. The same 5000 rupees with same 13% return. So at your 60, that is 30 years of investment, you will be having just 2.2 crores. It is such a massive difference between 8 crores and 2.2 crores. Look at the difference. Had you started at your 20, you would be having 8 crores instead of 2.2 crores. So think of investments as early as possible. You can handle risks at your 20s. It doesn't matter even if it does not work out today. It does not matter how small is your amount. It's always important to start. Remember one thing, whatever may happen over the long term, you'll always be gaining. Patience is the key in the market. So even if you look at the COVID stats, it will not affect over the long term. Again, this is not a financial advice video, this is just an informative video. This video is just to give you the idea of the magic of compounding. So there are many other awesome channels where you can learn a lot for starting your investment journey. So always remember, patience is the key. So this was all for this video. If you liked the video or if you learned something new, please do like and do share and also subscribe to the channel. Don't forget to comment your thoughts. We'll meet at the next one. Until then, bye.